So, you want to buy a shopping mall. You dream of a big, empty building. You fill it with thriving retail stores. The monthly rent checks roll in daily. Hundreds of shoppers walk past your units. Every store pays for the privilege inside. It sounds simple on the surface level, but let me tell you, it is not. The story of malls is truly strange. It is a wild tale of real estate. It is a story of money and death. Before you make a single dollar bill, you must survive the massive building costs. A regional mall is not a toy. Building one from scratch is incredibly expensive. You need land, parking, and complex plumbing. Electrical systems and climate control take millions. Permits take a small mountain of paperwork. You spend hundreds of millions before opening. The land alone costs tens of millions. You pour concrete and put up steel. You run miles of complex electrical wiring. Multiple levels of parking require huge investment. Local zoning laws add more financial pressure. By the time the ribbon is cut, you have spent more than a hospital. Buying an existing mall is usually cheaper, but that is where things get complicated. Not every mall is the same mall. There is a massive gap in quality. Class A malls are the top tier. They feature luxury stores and wealthy suburbs. They have high sales per square foot. There is a waiting list for space. Those trade for $1 billion total. The income they produce is very stable. Then there are the lower tier malls. These buildings are old and have leaks. They have weak stores and poor neighborhoods. Some sell for a fraction of costs. One mall in Ohio sold for nothing. It once had over 100 stores. It kept losing tenants and value daily. So here is the secret of malls. You are not really buying a building. You are buying a bet on neighborhoods. The price tag tells you the story. Most owners today do not own personally. They use a real estate investment trust. AREIT is a special company structure. It owns property and pays out profits. It avoids paying corporate income tax daily. This structure is how malls survive today. Ordinary people buy shares on the stock. You pay the price of a coffee. You never deal with a leaking roof. You never deal with a failing store. The largest companies own 100 centers. They spread risk across a large portfolio. That is different from a private buyer. A private buyer puts everything in one. Say you have settled on a purchase. Before you collect your first rent check, you face costs that catch owners off guard. First, there are the old anchor leases. You do not get to renegotiate them. Department stores signed them many years ago. They often pay shockingly low rent amounts. You are stuck with the previous deal. Second, there is the deferred maintenance list. Roofs leak during the heavy rainstorms. HVAC systems wear out over the years. Parking lots crack and need fresh asphalt. Escalators and elevators require constant, pricey service. If the owner cut corners to save, you pay the bill during the winter. Third, there are the co-tenancy clauses. These are hidden inside every mall lease. They say if an anchor store closes, smaller stores can pay much less rent. Sometimes they can walk away entirely free. You do not see this on day one, but one anchor leaves and chaos follows. Suddenly, a dozen tenants pay you nothing. The mall looks full on your papers, but the financial structure is shifting fast. Here is how a mall makes money. It is layered in ways people ignore. The first layer is basic monthly rent. Every store pays for their specific space. It is priced per square foot yearly. Small specialty stores pay very high rates. Department store anchors pay very little money. They pay 1/10 of the small shop. Why would a mall owner allow this? The anchor is not paying for space. The anchor is paying for its name. The anchor brings in all the customers. Those customers walk past dozens of stores. The owner rents foot traffic from anchors. The small shops subsidize the anchor discount. They pay full price to be near. The second layer is the percentage rent. This is money tied to store sales. It is on top of the base rent. If sales cross a specific breakpoint, the mall takes a slice of sales. It is a small percentage of profit. It scales with how the mall performs. The owner makes money without doing work. The third layer is common area maintenance. This is separate from the base rent. It pays to clean the public floors. It pays for lighting the long hallways. It pays for running the security teams. It pays for the moving escalator stairs. Tenants pay based on their square footage. This means you do not pay everything. The tenants build it back to you. Then there is a fourth category here. Everything that is not a retail store. Parking fees in very dense urban malls. Advertising space on bright digital screens. Kiosks sitting in the middle of paths. They charge very high rent per foot. They take up almost no real space. They sit where the foot traffic is. Pop-up events and holiday markets add money. None of these show up in pictures. But for some, They slice total income. A tiny cart selling cheap plastic sunglasses in the busiest intersection of the mall can be a very valuable real estate. Position is worth more than total space. Size and rent are not the same. The mall is a machine for money. It prints money from 4 distinct directions. Now, consider the other side of costs. Utilities on buildings this size are huge. Keeping 1,000,000 feet climate controlled daily is one of the largest recurring expenses. Add to that the cleaning contract costs. Add to that the security staffing teams. Landscaping and snow removal add more pressure. A broken sprinkler is a massive bill. A cracked tile needs immediate expert help. Operating bills run into hundreds of thousands. This happens before you pay the loan. Then there is the local property tax. This is a huge yearly line item. Insurance has been climbing very sharply lately. Older buildings face very high insurance costs. There is a detail in the CAM. Shared costs do not shrink when empty. Hallways must be cleaned, regardless of stores. Lights above vacant stores still need power. Security must patrol the entire large building. When vacancy rises, the pool gets smaller. Each remaining tenant pays a higher bill. Rising vacancy raises costs for everyone else. This pressure pushes marginal tenants to leave. Even a full mall can lose money. It depends on who pays real rent. If half the space pays next to nothing, and half is on short-term discounted leases, the cash flow is actually very weak. Occupancy is not the same as income. That distinction causes many malls to fail. Before we discuss how malls die, understand what developers figured out long ago. They designed the building around human movement. They spaced anchor stores 3 blocks apart. Shoppers must pass smaller stores to walk. Escalators are at the ends of hallways. This forces you to walk the length. Skylights with mixed lights hide the time. You lose track of how long passed. None of this is for the decoration. Every choice maximizes the storefront you see. That is the entire logic of malls. Force movement to increase the visual exposure. Exposure is what small tenants pay for. Now consider the structural risk here today. For years, department stores were the backbone. They were the reason malls got built. Banks needed that guarantee of foot traffic. Starting in the 2000s, things changed fast. Department stores began closing at rapid speeds. Sears filed for bankruptcy protection in 2018. One mall owner had 50 Sears stores. Across the industry, anchors were in malls. This mattered more than any other store. Remember those co-tenancy clauses and contracts? When an anchor closes, others pay less. One closure triggers a wave of reductions. Dozens of stores pay nothing to you. Filling anchor space back up is hard. These buildings were built for one tenant. Enormous floor plates do not convert easily. One owner spent millions just to subdivide. Multiply that cost across many anchor boxes. You understand why bankruptcy causes real pain. A mall fails when one piece falls. The structure was built to depend on. To understand this, look at Rolling Acres. It opened in Ohio in the 70s. It had 20 stores and a Sears. It grew to over 100 stores. It was a very busy shopping destination, but slowly, the anchor stores began leaving. A competing mall opened nearby the town. It pulled all the shoppers away quickly. One anchor closed due to poor sales. By 2006, occupancy fell to the bottom. It sold for a fraction of value. A building once valued at $30 million. The interior of the mall finally closed. 2 anchors stayed open with outside doors. Sears finally closed in the year 2011. The last tenant left in late 2013. The building sat empty for many years. What happened next is a tragic story. The empty building attracted many bad scrappers. They tore out copper wiring for cash. A man died stealing copper from boxes. Vandals broke the skylights for the fun. Rain and snow poured into the building. The floors and ceilings rotted from inside. The city took ownership of the land. Owners had stopped paying all property taxes. The city demolished the building in stages. Amazon built a warehouse on that land. Keep this in mind for your mall. Full occupancy does not mean safe daily. It took 2 decades to reach rubble. The line between states was not dramatic. It was a sequence of smaller events. Each made the next one more likely. The collapse did not happen in isolation. Online shopping took a huge retail share. The core product was convenience for years. If you wanted variety, malls were best. That convenience was the reason you drove. Online shopping broke the mall monopoly daily. You compare thousands of options from home. You never deal with parking or lines. The original reason for existence simply stopped. This is why malls struggled the most. They were stuck in the middle ground, not upscale enough to sell an experience, not cheap enough to compete on price. The weakest malls were hit the first. Strong malls grew stronger than ever before. Weak malls grew weaker than ever before. The owners who kept properties alive changed. They stopped selling only clothing and shoes. They filled boxes with things for screens. Restaurants require you to leave the house. Gyms and studios provide a physical service. Medical clinics need a real physical location. Entertainment venues draw the crowds in daily. Some owners converted wings into luxury apartments. They turned retail into a mixed-use space. Several income streams replaced the old single. The idea is simple, but very expensive. Malls stopped selling products to the shoppers. They started selling reasons to leave home. Reasons that online shopping cannot deliver today. Does owning a mall work as a business? The answer depends entirely on your mall. The gap between success and death is, in the optimistic version, you are rich. Your location is strong, with heavy traffic. Your mix of services is very smart. Base rent and percentage rent bring cash. Property values climb as the neighborhood grows. This made the biggest companies very wealthy. This made many developers into local billionaires. In the realistic bad scenario, you lose. A single major anchor store leaves you. Co-tenancy clauses trigger rent drops for all. Remaining tenants leave when leases expire soon. Utilities and insurance keep rising every year. The empty anchor sits there for years. It generates zero income while costs persist. The fixed pool of costs gets split. Remaining stores pay more for the hallways. The difference can be a growing asset. It can also be a failing liability. Neither scenario is exotic or purely theoretical. Both happen constantly across the whole industry, sometimes to the same building, 10 years. Rolling Acres lived the optimistic version first. It was a beloved local landmark then. It slid into the realistic failing version. The building itself did not change here. The economics underneath it changed very fast. A mall looks like a store building. From inside, it is a financial system. Every tenant's fortune is tied together now, whether they realize that fact or not. The anchor does not just sell items. It sells traffic that the mall needs. When it leaves, it pulls the floor. The building is not really the business. The people walking through it are revenue.